Welcome to our deep dive on whether the FHA loan can become a financial trap in today's high-rate, high-price market. We will unpack how low down payments, elevated interest rates, and rising home values can combine to make buyers house poor. Then, we will provide a practical framework to keep your housing costs under control, including the 30% take-home rule, down payment strategies, and realistic budgeting. Additionally, we will compare FHA and conventional loans, run sample numbers, and offer a step-by-step game plan to avoid costly mistakes. Finally, we will test your understanding with quick quizzes and wrap up with key takeaways. First, let's set expectations with a brief agenda. In this video, we will start with the market context that is pushing many buyers toward low down payment options. Next, we will examine why this often leads to unaffordable monthly payments. Then, we will compare FHA and conventional loans and explain the 30% of take-home pay guideline. After that, we will walk through example monthly costs on a $500,000 home at current interest rates. Furthermore, we will discuss cash reserves, income realities, and relocation as a lever. Finally, we will outline a step-by-step plan and test your knowledge with quick quizzes. Now let's begin with a quick disclaimer. This content is for education only and does not constitute financial, tax, or legal advice. Mortgage rates, loan programs, taxes, insurance, and closing costs change frequently and vary by location and personal qualification. You should consult a licensed mortgage professional and a fiduciary financial planner before taking action. With that clarified, let's set the stage for why so many buyers are feeling squeezed. The current environment of elevated mortgage rates near 8 to 9%, paired with median home prices hovering around $500,000, creates a challenging affordability picture. Buyers using low down payment loans are encountering total monthly housing costs, including principal, interest, taxes, insurance, and mortgage insurance, that frequently cross $3,000 to $5,000 per month. This often results in being house poor and undermines savings, lifestyle choices, and readiness for inevitable repairs. Next, let's break down how these pressures compound. House poor happens when a buyer stretches to purchase with a small down payment amid high prices and high interest rates. First, a low down payment raises the loan-to-value ratio, which increases both the base loan amount and the requirement for mortgage insurance. Second, at 8 to 9%, the principal and interest component alone becomes very large. Third, property taxes and homeowners insurance add significant fixed costs. Combined, these elements push total monthly housing costs into the $3,000 to $5,000 range for many buyers at the $500,000 price point. Consequently, savings and lifestyle spending shrink, and even moderate unplanned repairs can become destabilizing. Next, we will visualize where the payment actually goes. This pie chart illustrates the proportion of total monthly housing cost for an FHA loan, with 3.5% down on a $500,000 home at 8.5%. The principal and interest slice is the dominant share. Taxes are the next largest predictable line item. Homeowners insurance is smaller but still material. Finally, FHA mortgage insurance premium adds a recurring monthly cost for most of the loan duration. Seeing the distribution underscores why small down payments at high rates create tight cash flows. Now let's compare FHA and conventional loan characteristics head-to-head. FHA loans typically allow lower down payments and more flexible credit criteria, which enables entry for buyers with smaller savings or thinner credit files. However, FHA requires an upfront mortgage insurance premium and monthly mortgage insurance that, for down payments under 10%, often persists for the life of the loan. Conversely, conventional loans usually require private mortgage insurance only when the loan-to-value exceeds 80%, and that PMI can be canceled upon reaching 80% loan-to-value or automatically at approximately 78%. Conventional options also avoid the upfront mortgage insurance in most cases, and often price best at 20% down. Next, let's quantify these differences with a sample monthly cost table. These figures are rough approximations, using an 8.5% rate on a $500,000 home, property taxes approximated at 1.2% annually, and homeowners insurance estimated at $1,500 annually. For the FHA scenario at 3.5% down, the loan amount is approximately $482,500, yielding a principal and interest payment near $3,706. Adding $500 for taxes, $125 for insurance, and approximately $221 for FHA mortgage insurance premium brings the total near $4,552 per month. The conventional 10% down scenario replaces FHA MIP with an estimated $300 of PMI that can be canceled later, for a slightly lower total. The conventional 20% down scenario eliminates mortgage insurance, lowering the total significantly. Your actual numbers will vary by rate, taxes, insurance, and credit profile. Next, let's anchor affordability with the 30% rule. A practical rule of thumb is to keep the sum of principal, interest, taxes, insurance, and any mortgage insurance at or below 30% of your monthly take-home pay. For instance, if your net monthly income is $9,000, a reasonable ceiling would be around $2,700. If your modeled payment significantly exceeds this threshold, your budget becomes vulnerable, increasing the likelihood of being house poor. It is wise to model best, base, and worst-case scenarios, including potential changes in income, recurring expenses, and maintenance outlays. Now, let's convert these insights into a concrete action plan. Start by calculating your actual net income and establish a firm 30% cap for total housing costs. Next, estimate your principal, interest, taxes, insurance, and any mortgage insurance using conservative assumptions on rates and property taxes. If 20% down is unattainable, aim for at least 10% to open conventional loan options with cancelable PMI. Build a liquid emergency reserve equal to 6 to 12 months of your total housing expense before you close. Also, allocate 1 to 3% of the property value each year toward maintenance and repairs. Avoid stretching your purchase price based on speculative appreciation. In high-cost regions, assess whether dual incomes or higher expected future earnings are necessary to remain within budget. Finally, if affordability cannot be achieved where you live, consider relocating to a lower-cost area to protect your financial flexibility. Now, let's visualize the buying journey and typical cost surprises. This sequence diagram illustrates the typical workflow, from pre-approval with a lender to working with an agent on the home search, submitting an offer to the seller, moving through lender underwriting, and finally closing with the title company. Along the way, pitfalls include interest rate changes if not locked, appraisal values coming in lower than expected which may create a cash gap, inspection findings that can increase repair costs, insurance quotes that exceed preliminary estimates, and post-closing repairs that were not fully captured in the inspection. Visualizing this timeline helps you proactively plan buffers at each step. Next, we will revisit the importance of maintaining substantial cash reserves. Maintain 6 to 12 months of total housing costs in cash or cash equivalents to withstand income disruptions or unexpected expenses. Budget 1 to 3% of the home's value annually for maintenance, recognizing that major systems such as HVAC, roofing, and water heaters have finite lifespans. Do not depend exclusively on a property inspection to avoid surprises. Inspections reduce risk, but do not eliminate it. Factor in the possibility of insurance premium increases as well. Next, to clarify decision paths, let's map the big choices on a mind map. This mind map puts affordability strategies into 4 decision paths. The first path is buying now, which may include pursuing a 10% down conventional loan, choosing a smaller home or different neighborhood, negotiating seller credits, or using a rate buy-down only when the total payment remains within the 30% cap. The second path is to wait and save, securing a larger down payment, building reserves, and improving credit to qualify for better terms. The third path focuses on increasing income through a second income, a career change, or supplemental income. The fourth path is relocation to a lower-cost area, potentially renting initially while learning the local market. Next, let's test your understanding with a quick quiz. Question: if your take-home pay is $9,000 per month, what is the recommended maximum total housing cost using the 30% rule? Options: $2,700, $3,900, or $4,500. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $2,700. 30% of $9,000 is $2,700. Keeping total housing costs at or below this threshold is a practical way to reduce the risk of becoming house poor. Now let's try one more question about mortgage insurance. Question: Which option allows mortgage insurance to be canceled rather than persist for most of the loan? Options: FHA with 3.5% down, conventional with 10% down, or conventional with 20% down with no PMI. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is conventional with 10% down, because PMI can typically be canceled once you reach approximately 80% loan to value, and it automatically terminates around 78%. FHA mortgage insurance often continues for the life of the loan when the down payment is under 10%. Meanwhile, a conventional loan with 20% down avoids PMI from the start. Next, let's lock in the most important takeaways. Your budget must drive your purchasing decision. Keep housing costs near 30% of your take-home pay to maintain financial flexibility. If 20% down is not practical, aim for at least 10% to access conventional loans with cancelable PMI. Maintain substantial liquid reserves and plan for ongoing maintenance. Buy for stability and long-term affordability instead of speculative appreciation. If local costs do not align with your budget, explore increasing income or relocating. Now, let's summarize and close out. In summary, today's high-rate, high-price market magnifies the risks of buying with minimal down payments. FHA loans offer accessibility, but come with ongoing mortgage insurance and high loan-to-value ratios that can strain budgets. Conventional loans at 10% down can balance accessibility and future PMI cancellation, while 20% down generally yields the best pricing and eliminates PMI. Use the 30% take-home cap. Build reliable reserves and stress test your numbers across multiple scenarios. If affordability cannot be achieved safely, consider increasing income or relocating. Finally, let's wrap up with a quick thank you and a call to action. Thank you for watching. If you found this valuable, please like the video, share it with someone who needs it, and subscribe for more practical finance breakdowns. Post your questions and experiences in the comments. Your story might help another buyer make a smarter decision.